Alright, so welcome, to another video on how to secure yourself financially. So, so what I'm going to do in this video is to recap everything that I have learned so far with the beginner guide to financial statement. Where now here I pass through, understand that if you're able to read nutrition labels or baseball box score or soccer box score, you can learn to read the basic of financing, financial statement, as well as you can read or apply for a loan or follow a recipe. You can learn the basic of accounting. The basic, they're difficult, they're rocket science. So this section will show us, right, how to gain some basic knowledge, especially when you are going to read financial statement, much like the CPR course teach you how to perform basic cardiopulmonary resuscitation. So these sections will train you to be an accountant, much like the CPR course won't train you to be a cardiac doctor, but it can give you sense and some confidence when you're able to look at a set of financial statements and make sense of them. So let's begin here with the to define what is financial statement. After all, according to the sec.gov, they show you the money. Okay? From the Cuba Gooding Jr. Immortal lines in Jerry Maguire movie, show me the money. That's what financial statement do, and there are several types of there. So 4 of them we have is the balance sheet, income statement, cash flow statement, and the statement of the shareholder. So the first show is what a company owns and what it owns at a fixed point in time. Income statements, how much money a company may and spend over a period of time. Cash flow is the exchange of money between that company and the outside world. And the statement of the shareholders that show is changing interest of the shareholders over time. So the TLDR of the balance sheet, right, is, well, that is a snapshot of the company assets, liabilities, and shareholders' equity, where the asset is anything that a company has that has value, whether it's intangible or tangible. Liabilities, obligations that a company have to pay off to their vendors, employees, or some other institution or some other entities. And the statement or the equity statement, what show is the amount of money if hypothetically the company liquidate all of its assets and pay off all its debt, so that the leftover money belongs to the shareholders. So generally this is the formula of the assets are equal to the assets are equal to liabilities plus the shareholders' equity. So generally this is list using that formula, or like in the case of Yahoo Finance. So when we look here to Yahoo Finance for Coca-Cola here, so they generally list on the assets at the top, followed by the liabilities and the shareholders' equity. So the assets are generally listed based on how quickly they can be converted into cash, whether it's current assets, meaning assets that can be converted into cash within a year or less. For example, the inventory, non-current asset that will take longer than a year, and fixed assets, which are not for sale because it helps your company to run your business, such as equipment, property, plant, office supplies. And when I look at the liabilities, which are generally listed based on their due date, you have short-term liabilities and long or current liabilities and long-term liabilities, as well as the shareholders' equity, which show the amount of money that the owners or the founders invest in the company assets or in the company stocks, since it is in sections, plus or minus their earnings or losses. So with that, okay, that can give you a sense of what is a balance sheet. So after all, this is a snapshot of the company assets, liabilities, and shareholders' equity, right? And then I look at the income statement, where now this shows how much money a company make and spend. The bottom line of this statement, when you look at the income statement for actually, when you look at the income statement, show you is if a company made a profit or not, right? So you can think of this according to the said.gov. You can think of this as a set of stairs that you start from the top with the total amount of revenue, and every time you go down, each step you make a deduction associated to earn that revenue, right? And at the bottom of the stair, you reach at the bottom line of this statement. So indicating is if this company made a profit or not. Okay. So we start with the total amount of revenue in the top of the stair, and then we go one step down in the stair on the stair. Then we go one step down in the stair, and you make deductions like merchandise returns or discount, no? And then you reach to the net revenue, right? So they call net because all the deduction from merchandise returns and uh, from the merchandise return and the discount has made from this gross revenue, all right? And then once you go down the stairs, one step at a time, the next is the cost of sale. So how much it costs a company to produce their good and service. Okay, so once you deduct that, you reach to the gross profit. So here's when you deduct things like the operating expense, meaning is expense that a company incur for their daily activities, like administering salaries, marketing, developing or improving existing products, or developing new ones. And then you also do some other deductions like the depreciation and amortization. You reach to the operating profits before interest and income taxes. So when you talk about interest, is source that can increase your revenue or decrease that. So for example, when you ask for a loan or when you borrow money when a company, for example, go through these money market funds, which they are funds that invest primarily in very short-term debt products such as bank acceptance, short-term debt issued by banks, or a certificate of deposit. All right, where this is a short-term savings certificate with savings certificate with short-term maturity, commercial papers, corporate debt, or repo, this government debt. So once you deduct that, okay, as well as the income taxes, then you look at the net income or losses. So that's the whole overview of that income statement, okay? And then the cash flow, which reports the inflow and outflow of cash over a period of time. This is important because much like people, well, they need to have cash on hand to pay this expense, okay, let's say rent, service, utility bills, or and purchase assets, let's say food or a bicycle, you know. So this statement use the information from the balance sheets and the income statement, and the bottom line of this show the net increase or decrease in cash over a period of time. So generally this is made when organized based on this kind of activity. So the cash flow review the cash flow from, or this statement review the cash flow from one of these activities. So operating, financing, and investing. I would like to remember the proper order here, because the order here matters. So you have operating activities, investing, and financing. Okay, so the first part of the cash flow statement, the operating activities, reviews the cash flow from by analyzing is the net income from the income statement, and then conciliate with the total amount of cash that was used or perceived from operating activities. So what are the most common operating activities? Well, you have operating or common operating activities are operating assets and operating liabilities. Okay, so the most common operating assets you have is inventory, accounts receivable, property, plant, and equipment, the prepay expense. So for example, expense that money incur for the promise or receive good and service over time. For example, premium insurance, like healthcare or like health for medical coverage, or your car or vehicle, house to protect those belonging in the case of any potential accidents. Long-term care, like home health care or nurse home care. Disabilities that prevent you from working. Liabilities in the case of a lawsuit, or life in the event of the policyholder's death. Also, you have marketing, rent, software license, office supplies, as well as maintenance contracts. All of these are just example of prepaid expense. Keep looking at other operating activities. Well, intangible assets, whether it's patents, which are exclusive right to inventors, so they can manufacture and distribute plus sell their inventions over a period of time. So for example, according to this very popular website called Popular Mechanics, where in that they show is the top 15 patent that changed the world. I just want to mention a few of them. Maglev, okay, this electromagnetic system or electromagnetic inductive system for stabilization and suspension for ground vehicles, right? So, for example, this maglev of this maglev train, okay. So the maglev train for that is a system of train transportation that use two set of electromagnets, right? And this was issued in 1969. Another example is GPS, this global navigation system using satellites with passing ranging techniques, as well as the electronic device like the iPhone, Chris gene editing for editing your genes, that kind of thing. Another intangible asset is copyrights, exclusive image, audio, or design that uniquely identified this company or that company from the competition. So, for example, even though it applied to a natural person, Michael Buffer, and his famous quote, "Let's get ready to rumble," right, in the US. Copyright, exclusive rights to creators of original work so they can manufacture, distribute, and sell their invention over a period of time. So, for example, you have Netflix, Twitter, Spotify, McDonald's. Trade secrets, confidential data that a company gain or use to gain some competitive advantage, whether it's on the process, customer list, or methods, as well as the as well as the Goodwill, which is the brand recognition, brand reputation, and customer loyalty. To keep looking at other operating or most common operating assets, investment in affiliates, okay, where this is a investment. Okay. So investment in affiliates, right? Yes. So investment in affiliates, such as joint ventures, a partnership between two or more companies to undertake a specific business activity, or projects where each part receives a share of the joint ventures. So, for example, Crocs and Post Malone equity investment, where now a company purchased significant amount of stake in the another company's stocks to raise its voice and potentially influence in the another company management decision, which is ultimately what it ends to happen, right? Such as Berkshire Hathaway, led by Warren Buffett, where this is a holding company that invests in a variety of sectors like energy, real estate, retail. Alphabet, which is the parent Google company that invests primarily in technology companies such as Calico. This long-term or this longevity company. SoftBank, SoftBank, a Japanese conglomerate that invests in a variety of technology company such as WeWork, Uber, Airbnb, TPG, Texas Pacific Group, a private equity that invests in industry like real estate or healthcare. So another examples are limited partnership, where now is an investor or a company that purchase stocks in the limited partnership in return of exactly so in return of control over the operating liabilities. Okay, so control over the operating assets and liabilities. Mm-hmm. Yeah, so to have control over the partnership assets and operations, okay, as well as the associate, where this is an investor or a company that owns around 20 to 50% of the another company stocks. So once I look at that, as well as the cash equivalent, which is another common operating assets, okay, like money market funds or cash, and now looking at the most common operating liabilities such as accounts receivable or accounts payable, where now this is money that a company owns to suppliers and vendors, usually short term, something between 30 to 60 days, for things like raw material, service, or office supplies. Accrue expense that a company incur for good and service that has been received but not yet paid for. For example, wage and salaries, rent, utility bill, taxes. Also, I look at deferred revenue, which is obligation that a company have to pay or to provide in the future for good and service based on money that has been collected. For example, subscription service, okay, Netflix, Spotify. So all of them they have an obligations to provide their service to customers. Or gift cards. So for example, Amazon. Okay. Then I also look at the income taxes payable, money that a company owns to the government based on their income, as well as the tax rate. So you have here corporate taxes in the U.S. is something between 21 or 20 or 19, all right, which is are very friendly to make business or to open a business and build a business out there or in their country. Withholding taxes, which is money that the employee retain from its employees, or it's money that the employer retain from the gross employee salaries to pay directly to the government. This is to, according to Investopedia, to promote the tax or the pay as you earn tax system, and to fight back tax evasions. However, if you're not working for a company, if you're a sole contractor, well, there are some other things that apply to you, you know. But that's the general kind of the thing, you know. Sell taxes, which is, for example, state sales tax or county or city sales tax that you have to pay to the city or the state. Also VAT, value added tax, a tax imposed on goods and service along the supply chains from manufacturing to distribution, where the customer ultimately pay the full VAT, and all business in the supply chain they remit that portion to the tax. Also, you have excise uh, tax, like good a tax imposed on certain goods like tobacco, alcohol, guns, gasoline, and GST, which is the tax imposed on the VAT, apply in countries like Australia, India, and Canada. Okay, so with that, all right. Well, I also look at other common operating liabilities like short-term borrowing. For example, for a company that wants to meet their financial needs or working capital with the promise of repay that within a year or less. So anytime they ask a loan for a bank, okay, or to a for if they have a line of credit, when they have a ceiling to how much money they can borrow, line of credit. They also can issue debt. This financial debt instruments like commercial paper, okay, trade is or trade borrowing. So when the company can reschedule the payments previous agreement with their suppliers and vendors, outstanding invoice. So a company can show it is outstanding invoice to a lender, and based on that, lender evaluate and decide, hey, you know what, this is the amount of money that I'm going to lend for you based on this, on the value of this invoice. Or the other is payroll advance. Now this is borrow money, provide to their employees, and well, they will be deducted on the next payday. Great, great, cool, awesome. Because with that, then I also look at something called notes payable, where now this is an agreement between the borrower and the lender, when the borrower tell and create a note to mention all the details on that loan, including the principal, the interest rates, the repayment schedule, among other details. So banks actually generate this note payable. Okay. For example, for a company they want to meet their working capital. The working capital is one of the metrics to see the health of a business, because it can show you is liquidity and short-term financial health. So meaning, well, it's the difference between the current operating assets minus the current liabilities. But keep looking at other notes payable, banks, companies, but now companies, instead of go to banks, they go to any financial institutions such as private lenders or venture capitalists, where now what they do is outline is the details about that loan. Trades, trades payable, but now this is to notes that the company can issue to their vendors and providers with a promise of repay them based on a particular agreement. So bonds is also a thing, all right? So governments as well as companies, so they issue this type of promise to repay that principal plus an interest, among other details. So with that, the subtle difference between the notes payable and the short-term borrowing is that notes payable is an agreement that is not based on time, okay? At least not in short term, meaning a year or less. Okay, all right, cool. So once I look at that, then I jump here is to the way how this income statement, these operating activities is calculated. Okay, so to do this conciliation between the net income and the total amount of cash that was used from operating activities, something that I described earlier, well, first, they look the net income and adjust for any non-cash items. So items that affect the state or the income of the company. For example, depreciation and amortizations, stock-based compensations, and also, it adjusts the total amount of cash that was used or perceived from other operating activities. Okay, so this is the operating activities. So it analyzes the cash flow from the net income and it adjusts or conciliate with the total amount of cash that was used for any operating activities. That's great. But now here with the investing activities, where now the cash flow or this statement show the cash flow from all investing activities, which is generally include purchase or sale of long-term assets. Okay, long-term assets such as intangible assets, patents, copyright, trademarks, goodwill, trade secrets, property, plant, and equipment. Okay, so even though when I ask here to good job. So long-term asset examples. I ask is for long-term, not liabilities. It's more like assets. Oh my God. Is here. So long-term assets, right? Share a link to this chat. Okay, they are now okay. They're expanding the capability of this. Okay, cool. So, example of long-term assets are that this is property, plant, and equipment, intangible assets, investment, goodwill, natural resource, Leasehold improvement. Okay, lease, in Spanish this is alquiler. Okay, alquiler, leasehold. Okay, leasehold, arrendamiento. Okay, so leasehold improvement. Okay, so this is example of these long-term assets, especially when we talk about is the financing activities, where now the cash flow review the cash flow, the financing activities that generally include is the purchase or sale of long-term assets, intangible assets, patents, copyrights, trade secrets, goodwill, uh, trademarks, property, plant, and equipment, investing or investing portfolio, or investment. Okay, so investment, leasehold improvement. All right, leasehold improvement. All of these are just example of long-term assets, right? So if a company, okay, if a company buys a piece of machinery, okay, or it buys, for example, it makes leasehold improvement, okay, so this activity will be registered as an outflow of cash because cash was used for that. Okay. However, if a company decides to sell some investment in their portfolio, okay, investing activities, well, this activity is registered as so yeah, this activity is registered. Okay, so this activity is registered as a cash, as an inflow of cash, okay, or as a cash inflow, because money was perceived from this activity. So this is kind of easy to understand. This investing activity generally include the purchase or sale of long-term assets, intangible assets, property, plant, and equipment, goodwill, uh, leasehold improvement. Okay, and when it comes to financing activities, okay, the third part. So now this statement, this cash flow statement, review from all financing activities. So I asked yesterday, what are the financing activities? Typically, that you borrow money or you lend to someone, right? This is the two core activities. The two core activities. So, or you borrow money from someone, or you lend money to someone. Okay. And typically, source of cash inflow. Okay, source of financing activities include cash raised by selling stocks or and bonds. Okay, which is a cash raised by selling bonds or stocks, or borrowing from banks. Likewise, paying back a bank loan will show up as use of cash flow, but meaning is as a cash flow, as an outflow of cash. Okay, because you have to pay cash, because you have to pay for that debt. Okay. Mm-hmm. Typical source of cash flow include cash raised by selling stocks and bonds or borrowing from banks. You know, but after all, you're getting is someone you're getting a finance from this. So this is a common or typical source of cash flow, okay, or inflow cash that include cash rates by selling stocks and bonds or borrowing from banks. Likewise, paying back a bank loan will show up as use of cash. Okay, so typical source of cash include cash raised by selling stocks. Okay, so typical source of cash include cash raised by selling stocks or by selling stocks and bonds or borrowing from banks. Okay, this is a cash right. Likewise, paying back a loan will show up as use of cash flow. So when I look at the read the footnote, a horse called Read the Footnotes ran in 2004 Kentucky Derby. He finished 7th, but if he had won, it would have been a victory for financial literacy proponents everywhere. It is so important to read the footnote. The footnote to financial statements are packed with information, and here are some of the highlights. Okay, so read the footnotes to financial statements and are packed with information. Here are some highlights. Here are some of the highlights. Significant accounting policy and practice. Companies are required to disclose the accounting policy that are most important to portray the company financial condition and results. So companies are required to disclose the accounting policy that are most important to the portrayal of the company financial condition and results. To disclose. Okay, allegedly, right? So companies are required to disclose, to reveal the accounting policies that are most important to the portrayal of the company financial conditions and results. These often require management most difficult, subjective, and complex judgment. So, for example, accounting policies. Okay, example of accounting examples. Revenue recognition, depreciation and amortization, inventory valuation, lease. This policy establishes how the company accounts for lease, whether they are classified as operating lease or finance lease. It may follow the guidelines set up in accounting standards such as International Financial Reporting Standard or generally accepted accounting principle. Goodwill and intangible assets, financial instruments, foreign currency, employee benefits, income taxes, contingencies, consolidation of subsidiaries, government grants. Okay. All right. So, okay, significant accounting policy and practice. Companies are required to disclose the accounting policy that is revenue recognition, depreciation and amortization, inventory valuation, leases, This policy establishes how the company accounts for leases, whether they are classified as operating leases or finance leases. It may follow the guidelines set up in accounting standards such as International Financial Reporting Standard or generally accepted accounting principle. Goodwill and intangible assets. This policy determines how the company measures and accounts for goodwill and intangible assets acquired through business combinations or internally generated. It includes policy or on impairments testing, amortizations and recognitions criteria. Financial instruments. This policy addresses the classification, measurement, and recognition of financial instruments such as cash, financial instruments, foreign currency translation, employee benefits, income taxes, contingency, consolidation of subsidiary, and government grants. Okay, okay, okay. So this is significant accounting policy and practice. This is read the footnotes, okay, and here are some highlights. So companies are required to disclose the accounting policy that are most important to the portrayal of company financial condition and results. In any way, company must be transparent. Company must be transparent. So company are not must yeah. So company must have its accounting policy transparent and public that are most important to the portrayal of the company financial conditions and results. This often requires management most difficult, subjective, and complex judgment. Income taxes. The footnotes provide detailed information about the company's current and deferred income taxes. The information is broken down by level, federal, state, local, and or foreign. And the main items that affect the company's effective tax rate are described. Pension plans and other retirement programs. Okay, the footnote discusses the company pension plans and other retirement or post-employment benefits program. The note contains specific information about the asset and cost of this program and indicate whether and how much the plans are over or underfunded. And stock options. The note also contains information about stock options granted to officers and employees, including the methods of accounting for stock-based compensation and the effect of the method on report results. This is something that you wouldn't get here. This is something that you definitely wouldn't get here. Well, actually, you have something called holders or options and analysis, earning histories, conversations and chart, Alright, okay, so that'll be all for this video. Take care, bye bye.